Hey everyone, and welcome to This Explainer. I am so thrilled to have you here today because we are about to embark on a really fascinating macro to micro journey through the world of corporate finance. Whether you're analyzing a booming tech giant or just your favorite local retailer, the underlying machinery of how businesses actually create value is absolutely captivating once you know how to look at it. So here's our quick roadmap for today. We're going to hit the modern business objective, look at core financial decisions, understand financial markets, dig into the time value of money, and finally wrap up with evaluating financial performance. Let's get right into it. Part 1. The modern business objective, strategy, and the triple bottom line. I absolutely love this quote from Laughley and Martin. They say, strategy is an integrated set of choices that uniquely positions the firm in its industry so as to create sustainable advantage and superior value to the competition. It's so crucial to realize that everything in finance, every single loan taken out, every asset bought, stems directly from this strategic pursuit. A company is constantly trying to uniquely position itself to create a sustainable advantage and ultimately superior value. But what does superior value actually mean today? Historically, the traditional objective was purely profit and shareholder wealth maximization. Basically, just make money for the owners, full stop. But companies aren't just isolated units operating in a vacuum, right? They exist within societies and ecosystems. And that's exactly why the updated objective has evolved into a much more holistic model, which is maximizing long-term wealth for all stakeholders. We call this the triple bottom line, focusing on people, planet, and profit. It's just a way broader, much more sustainable view of value creation. Moving on to part 2, core financial decisions, the value creation engine. Think of a company as a massive value creation engine. Management basically has 3 main levers they can pull to make it run. First is the financing decision. How do we responsibly obtain funds? Are we going to take on debt or issue equity? Second is the investing decision. Okay, now that we have the money, how do we invest it into capital assets or acquisitions for the absolute maximum return? And third, the dividend decision. Once we actually generate a profit, do we optimize those returns by giving cash back to our shareholders as dividends, or do we retain those funds to fuel even more long-term growth? All right, part 3. Understanding financial markets, where capital flows. Financial markets are essentially the grand meeting place of the business world. They act as this massive connecting point where buyers who are seeking out investments meet sellers who need to raise capital. Broadly speaking, there are 4 main types you really need to know: capital markets, money markets, the forex market, and the derivative market. Now, for corporate finance, we're going to zoom in specifically on capital markets. By definition, these are the markets that trade in long-term finance. This is exactly where companies go to fund their major multi-year strategic moves. And we further divide these into primary markets, where brand new securities are issued for the very first time, and secondary markets, where existing ones are traded back and forth among investors. To anchor this in the real world, just think about the Johannesburg Stock Exchange. The JSE is a prime example of a highly sophisticated capital market in action. When a major South African corporation needs to finance a massive new expansion, this is the vital ecosystem that actually makes it possible. Which brings us to part 4, time value of money, the mathematical engine of finance. I want you to consider a seemingly simple question. Why exactly do borrowers pay interest to lenders? It seems obvious, but it really comes down to a fundamental truth of finance. The borrower firmly believes that the potential value they can create with that money today will actually exceed the total cost of borrowing it over time. On the flip side, lenders and investors absolutely demand compensation for parting with their hard-earned cash. And why is that? Well, it's because of 3 crucial elements. First, the pure time value. Having money in your hand today is inherently better than having it tomorrow because you could be using it or investing it right now. Second, compensation for risk, the very real probability that things might go wrong and you don't get paid back. And third, inflation, the unavoidable fact that money just loses its purchasing power over time. To actually figure all this out, you'd use something like a Casio financial calculator. These devices have built-in functions, like net present value, or NPV, which are absolute game changers. This isn't just abstract theory. We use precise variables, like PV for present value, FV for future value, and PMT for periodic payments, to mathematically translate what today's cash is worth in terms of future cash flows. It is literally the mathematical engine that drives all of corporate finance. Finally, part 5, evaluating financial performance, measuring success through ratios. So, how do we diagnose if a company's strategy is actually working? We extract relevant data from their financial statements and use ratio analysis. We typically look at four main diagnostic categories: liquidity, asset management, and profitability. These ratios allow us to evaluate business risks and compare performance, completely regardless of the company's size. Let's start with liquidity, specifically the current ratio. This measures how many times a company's current assets exceed its current liabilities. The absolute crucial point here is survival. A company simply must have enough easily convertible, liquid assets on hand to settle its short-term debts. If this ratio dips too low, the business is in immediate, serious danger. Let's look at some real-world data from our source example, Sneakers for All Ltd. We can look at their current assets compared to their current liabilities over 2 years, which we'll call X5 and X6. In year X5, their ratio was sitting at 1.81, but in X6, it climbed significantly to over 3.3. This tells us their ability to confidently cover short-term debts improved dramatically year over year. Next up, let's look at asset management with the inventory turnover ratio. This calculates cost of sales divided by inventory. It essentially measures how efficiently or productively a company is using its assets to generate sales. Basically, you want to know how quickly that stock sitting in the warehouse is successfully converting into actual profit-generating revenue. Applying this to Sneakers for All Ltd again, we divide their cost of sales by their inventory. Their ratio went from roughly 19 in year X5 to over 22 in year X6. A higher turnover generally indicates highly productive asset utilization. They are moving their sneakers off the shelves much faster, which is exactly what you want to see as an investor. Ultimately, though, all of this leads to profitability. Remember those core decisions we talked about earlier? We measure profitability by looking at metrics like earnings per share and the dividend cover ratio. These tell us directly how much actual earnings the company is generating and, importantly, how much is being safely retained for future growth versus being paid out as dividends to the shareholders. But here's the catch. A ratio on its own is just a number in a vacuum. Evaluating a business requires a really potent combination of mathematical ratio analysis and historical comparability. We have to compare these percentages and multiples against the company's previous periods, its direct competitors, and overall industry standards to truly understand if management is succeeding. Which leaves us with a really fascinating final thought to chew on. We've mapped out this entire journey, right? From overarching strategy down to the mathematical ratios. But if a business perfectly optimizes all these metrics and truly maximizes its long-term firm value, what unpredictable new global risks, like shifting geopolitics or crazy disruptive technologies, emerge as they expand their footprint? Mastering these financial tools isn't the end of the story. It's really just the essential foundation for navigating an ever-changing world. Thanks so much for joining me on this explainer, and definitely keep questioning the numbers.